Welcome to the Way to Build Wealth. I'm Ethan Block, and I'm helping you build wealth. Welcome to the show. We're talking about stocks today, or more importantly, why stocks are one of the most lucrative ways to build wealth. Whether it's through index funds, which we're going to talk about coming up in the next couple of episodes, I believe, or through individual purchases of common stock, which we'll talk about way further down the road here on the Way to Build Wealth. But, most importantly, this episode is all about explaining to you why stocks are one of the most lucrative ways to build wealth. I think it would be great to tie in the different B cubed P's we've talked about in the past, inflation, time, and compound interest, and show you how stock matches up on each one of them. So let's get right into inflation in relation to common stocks. So stocks are amazing, really good inflation fighters. Because stocks are real ownership stakes in businesses, those businesses have the ability to fight inflation, either A, through taking a hit in their profit margins, or B, raising their prices during times of inflation or inflationary periods. And in an example I'm going to get into a little bit later in this episode, I'll show you how stocks have held up over the past 200 years after the treacherous effects of inflation. But stocks are known to be extremely good inflation fighters. Time. Whether it's an index fund or individual stocks, if you find good index funds or good individual stock investments, you can hold them, hopefully, for a long-ass time, maybe your entire lifetime, and that would rock. So they got the time thing covered, locked into place. Finally, compound interest. You can, depending how ambitious you are, get pretty ridiculous rates of compound interest or rates of return through common stocks. One of the greatest investors of all time, Warren Buffett, has locked in about a 20% CAGR, compound annual growth rate, through, investing in common stocks and all the other investments he makes, but still a 20% compound interest rate over a 40-year time period. That is ridiculous. So they got the compound interest locked in as well. So we've covered inflation, time, and compound interest. And now, any type of investment that ever comes up for you down the road, I think it's wise for you to stack it up against, inflation, time, and compound interest. Because as we talked about, those are the three keys for building wealth, understanding them and utilizing them. So let's break out an example to show you the power and just the return that stocks have given over the past 200 years. And a very simple example. $1 invested in the broad-based U.S. stock market in 1801 and held for 200 years' time would have been worth $8.8 trillion in 2001, 200 years later. Now that's with reinvesting dividends throughout the whole 200 years, but still $1 to $8.8 trillion. Now this is where we bring in the inflation monster. Let's open the door. Let's let the monster in. Come on in, good friend, bad friend. Inflation. After inflation, that $8.8 trillion would be whittled down to a purchasing power of just almost $600,000. Inflation is treacherous. You know what I'm saying? Nonetheless, $1 to $600,000 in purchasing power over a 200-year time period. So how does that stock stack up against other liquid investments like government bonds or bills or gold? Let's find out, shall we? I got a great graph in here. By the way, this is Stocks for the Long Run by Jeremy Siegel. I know it's been sitting next to me the whole episode. I can link up a book review I've done on it right down below. Now I'm going to have to get up today because Tim's not here to show you this graph. Hopefully I don't break anything. So as I hold this here and explain it, so this top line, this bold line is stock. That's 1801, 2001. And this shows the growth of $1. In stocks, you're looking at about $599,000 at the end of the 200-year time period. And remember, this is after inflation. And you have government bonds, $952. Just that in its own right is remarkable. You're talking about $600,000 versus $952. That is Tremendous. That's a massive gap. And this graph doesn't really do it justice because I had to fit everything in. Then you have bills, $304. It's getting worse, guys. Then you have gold. People always like gold, brilliant investment, good way to hold money. Now, granted, gold has its advantages, but over a 200-year time period, you would have lost 2 cents in purchasing power. It would be worth $1 in gold would be worth 98 cents in purchasing power today. And finally, if you would have held $1 in cash over 200 years, it would have a purchasing power of just 7 cents today. So that guy you know who holds cash in his mattress, you probably want to find that graph and show him that. So getting back, that is an extremely powerful example, and these are all liquid investments, obviously, and stocks just dominate. It's unbelievable. And like I said, whether you're investing them through index funds, which is the best way for the average person to own stocks, which we're going to talk about coming up, I'm very excited about it, or in individual common stocks, which depending on how well you've built out your investment aptitude, which we will also be talking about in future episodes, you can do really well as well. That's it for today. I hope you understand, and I'm going to leave it with this. Stocks are one of the most, in my opinion, I'm a huge fan of stocks, so, the most lucrative way for you to build wealth and sustain wealth over a long period of time, and that is what matters. I'm Ethan Block, and I'm helping you build wealth.